There is a lot going on the U.S. Treasury yield curve, starting at the front end in the 4-week bill. Over the last couple of weeks, the 4-week bill rate has been moving down, but over the last couple of days of this past week, the 4-week bill rate has plunged to the point that Friday, the 4-week rate was at 423, which you'll notice that's 2 basis points below the Fed's RRP floor and therefore below a whole bunch of alternative rates, which suggests heightened demand for 4-week bills. And we know at Eurodollar University what that's all about. But that's just where it begins. We also saw the 3-month 10-year spread reinvert again this past week. It kind of it uninverted again on Friday, but reinversion in the curve suggests that the market is thinking one thing about the fundamentals in the economy and something different about what the Federal Reserve thinks about the fundamentals in the economy. And on top of all that, we've got more central banks cutting rates and cutting rates aggressively around the world. The latest was the Reserve Bank of India, who dropped its policy rates by 50 basis points for a total of 100 basis points in rate reductions just in the past 4 months, as the banking sector in India looks increasingly shaky due to global uncertainty. That's the term that we keep hearing pop up. So we've got lots of demand for front end instruments in the US Treasury curve. We've got stuff going on the long end versus the short end, plus not just the Reserve Bank of India, but all of these central banks around the world that are cutting. And the Federal Reserve is sitting here saying, well, we're just going to wait and see. So, Steve, where do you want to start? Let's start maybe at the front end of the yield curve, the 4-week bill. For some reason, all of a sudden, over the last couple of weeks, but really this past week, the market can't get enough of these instruments.
Yeah, Jeff, and it's like a very clear sign that there's something wrong in the financial system. Now, it doesn't mean something seriously is wrong. It just means all of a sudden you have a demand for collateral. And the question is, as you said, it's lower than the RRP rate. So why? Why are they after this? Now, we don't know exactly why, but it is a red flag. It's telling us, look, this notion we're going to see inflation and growth, you wouldn't see this in the 4-week bill. If it was falling, well, that tells us that growth and inflation are coming down, tells us there's problems in the financial system, tells us people want collateral. We don't know why yet. And hopefully we don't find out why. But for the moment, it's telling us some people are panicking.
Yeah, Steve, I think you're right. It's not one of those catastrophic things where you think, oh, God, this is the end of the world. It's one of those red flags that goes up that you say, okay, this is something we want to keep an eye on. And the reason is, just to be clear for people who are maybe not familiar, when you see a 4-week Treasury bill rate at 4.23%, what you have to do is compare that to other alternatives in the investment in the money marketplace. Because right now you can get 4.4% at the Fed's window, the IOR, or interest on reserves. So if you just have spare bank reserves, the Federal Reserve is going to give you 4.4%. So you wouldn't necessarily want a Treasury bill yielding 2.23% when you can get 4.4% for just leaving reserves on with the Fed. Money market rates in the repo market, SOFR's been around 429 at the low, but really in the low 430s. So you have an alternative there where you can just, if you've got spare cash, you can just lend it basically risk-free in repo and get, say, 432, rather than lend it to the U.S. government Treasury for 4 weeks and only get 423. In fact, the Federal Reserve's RRP, which is at 425, you at the very minimum you could put some spare funds with the Fed. You get 4.25% completely risk-free. So the very fact that the 4-week Treasury bill yield is at 423, below all these other things, in no uncertain terms, what that means is there's more demand for this particular instrument than it would be otherwise for the investment characteristics, these returns on interest rates. So there's heightened demand for specifically 4-week bills, which, spoiler alert here, everybody at Eurodollar University knows the answer to this. It's usually because there's some tightness in collateral. Now, to be clear, we don't really see any other warning signs that are breaking out that suggest there's something really bad going on. So right now, this is one of those things that happens every once in a while that you have to pay attention to, because it suggests there's something there, even if we don't know what it is, nor do we know how serious it is, but it's serious enough that it's got the 4-week bill doing things it otherwise shouldn't be doing.
Yeah, that's right, Jeff. As you said, it's not about yield. If somebody was looking for yield, there has plenty of alternatives. This is all about holding collateral. Now, again, if the 4-week bill was plunging, if it dropped, say, a full percentage point, yes, that would be okay.
That would be the
Sound
end of the world. That would be
Right.
get the hell out
Sound
of
the
Dodge.
fire alarms. We have a
Yeah.
problem. But this is still telling us people want collateral. There's a reason they want it. But we also know when we go out and look at the 310s, what are we seeing? Inversion is back. So we're seeing signs that, yes, the U.S. economy is slowing. Financial conditions are tightening. The worry about inflation, well, if there is going to be inflation, we know it's only going to be transitory. Of course, demand being, of course, weaker as well. So, yes, you're right. We're seeing all across the curve. A lot of things are starting to pop up. Again, nothing that's sounding alarm, but just telling us the trajectory of the economy is going to go in a different direction than a lot of these central bankers think.
Well, sticking with, I know we want to talk about the 3-month 10-year spread, which is an important thing too. But before we get to that, one last note on the 4-week bill. What we have seen is that dealer coupon holdings, and I know coupon holdings and Treasury bills, it kind of gets mixed up there. But what primary dealers do when they anticipate collateral scarcity to become a profitable issue, what they'll do is they'll hold lots of Treasury collateral of not just bills but also in coupons, and they'll hold it because they anticipate that other market participants are going to be in high demand for U.S. Treasuries specifically, and they seek to profit off it. They also do it defensively too, like they protect their own balance sheet by making sure they have availability of Treasury coupons in case they need it for their own purposes. But either what we see happen is that primary dealers will load up on Treasury securities, anticipating difficulties in repo markets and collateral circulation that will then allow them to either profit from it or be insured against it because they have Treasury bills. So we have seen dealer holdings of coupons stay near record highs for the last several months. It surged to a record high in January and February, and it kind of stayed around more than 300 billion, which is an enormous amount for primary dealers to hold in inventory. It's been above 300 billion or close to 300 billion ever since then. And the latest week, the latest weekly data, which just came out for the prior week, was right there at 300 billion too. So what that suggests is very modestly, like we're just talking about the 4-week Treasury bill, dealers are seeing something that they think might be worthwhile holding additional collateral in the form of notes and bonds in their inventories, maybe because there's something happening behind the scenes, and that behind the scenes is starting to peak out in terms of the 4-week Treasury bill yield that's going below all these other alternatives. So there is corroboration in certain places for not necessarily catastrophic collateral conditions, but some form of strain and stress that has heightened demand for at least 4-week bills, as well as primary dealer demand for coupons. So that's the front of the curve. That's the stuff that relates to collateral. Now let's talk about the yield curve shape. What we saw this week, Wednesday and Thursday, is that the 10-year Treasury yield that's been moving lower over the past several weeks of de-risking and risk aversion across the marketplace that we've seen in a number of different ways. Like, the Swiss franc got stronger for one, swap spreads that continue to be incredibly negative. So you've seen the 10-year kind of move lower, but the 3-month is relatively steady to the point that the 10-year moved below the 3-month, which, as Steve will tell you, that tells you the market is saying Jay Powell's going to be slow.
Yeah, absolutely, Jeff. So when we look back at the 4-week, we understand the financial system is collateralized and there is a demand to hold those. But as we move out the curve, we find out some very interesting relationships. You mentioned the 3-month, very correlated, of course, to the central bank's policy, to the funds rate. And what is it telling us? That the Fed's probably not going to cut rates at their next meeting later this month. But I think that's the general knowledge of the financial world. Everyone believes and is telling the Fed, you're not going to cut. And the Fed's saying, hey, we're probably not going to cut. And the bond market is validating that. But the 10-year inverting below it. Now, this is where it starts to get interesting because we can look and say, okay, maybe there's some issues in tightness in the financial system at the 4-week level. We know the Fed's not going to cut. But the 10-year, that's telling us the growth and inflation expectations are coming down at a time. What is the Fed telling us? We're worried about inflation. At the same time, they can't see what's happening with the labor market. So yes, this is, to me, is far more interesting than what's going on in the plumbing because it's validating that all this hope that the economy was going to turn around and boom, that consumers were going to absorb these higher prices and spending was going to persist. What we're seeing is kind of the opposite here. 10 years telling us that there's other problems that could be far more severe than just a short-term collateral issue.
Yeah, I think that's part of the issue with the Treasury curve itself is that there's this belief that a lot of people believe, like Jay Powell does, that the economy is resilient and we need to be worried about inflation expectations. But with the 10-year falling and with the yield curve acting the way it has, what the market is kind of suggesting is that there's no short run path. And if, like you said, Steve, the Fed is going to hold here. They're not going to cut in June. I mean, as much as So the president certainly wants Jay Powell to cut. That's been his message all week. The Fed's not going to do. They don't see anything that would suggest some kind of immediate need for dropping interest rates. But there's more of a debate and more of a consideration and more of an argument about when the Fed actually moves again, because I think there's across the entire marketplace there's an expectation they're going to have to do it at some point. And to me, it's starting to look a lot more like last summer. I mean, it's eerie how similar it is. If you remember, last summer we got into April and May, and then June. A lot of the economic data started to turn negative. We started to see the same things in the yield curve, where longer term rates were coming down. The 2-year yield was coming down. The Fed kept saying, no, we don't believe there's any reason to cut. We're worried more about inflation. And then when you got to June and into July, and we had this discussion, remember, Steve, in the July meeting, where the Fed came out publicly and said, no, we're still worried about inflation. We're still not anywhere near a rate cut. But then a couple of weeks later, they said, oh, we actually were considering a rate cut in July. We just didn't want to tell anybody. So they were ready to cut in July because the situation had shifted that much over the first couple of months of summer. And I think we're laying the groundwork for something similar here, where the Fed's going to say, right up until the end, we don't want to cut. We're still worried about inflation, but you can see all the economic data and these market signals suggesting, like last summer, they may not want to do it today, but at some point very soon, they're going to be forced into doing what they did last year.
Jeff, I couldn't agree more. I think that's exactly what happens. I think Powell's going to say, again, we're not going to cut rates. We're worried about inflation. And when you think about it, they have a dual mandate. They have to worry about inflation in the labor market. The problem is they worry about inflation until it's too late for the labor market. Again, we talk about why central bank policy doesn't work. Well, there's one key part to that is people that are out of work, they can't get a loan. So it doesn't matter. You can lower rates all you want. But when you go to the bank and they ask, well, what's the first question on the loan app? Tell us about your job. And you say, well, it's called my unemployment check. It doesn't matter. You're not going to get a loan. So what we see here from the Fed is the typical Fed expectations. We're worried about inflation. We think tariffs are going to drive inflation higher. There's absolutely no evidence that that's going to happen. Now, we do see some companies saying, look, we're being pressured into raising prices. We've done everything we can, so they're going to go up. But does that mean we're going to see the CPI shoot higher like we saw in the expectations from the University of Michigan survey? Probably not anywhere even remotely close to that. But what we're seeing when we look at, say, the non-farm payroll report, which we know Jay Powell will come out and say, look, this is A-OK, but reality is we have 95,000 in revisions. We also have on average 55,000 in revisions on any given report. It tells us the labor market here is weakening. Again, problem, I think, Fed doesn't want to appear they're pandering to the Trump administration. I think they're way behind the curve if I did believe it worked, but nevertheless, I think from Fed's perspective, they're behind the curve. They will cut probably in July, but his only response will be is, yes, we're talked about it, we're considering it, and then after the meeting's over, we're going to hear all kinds of Fed speakers saying, yeah, we talked about it, we're really thinking about it, and if things go down, we're going to have cuts later this year. I think that's what happens.
Yeah, it's the psychology, right, Steve? Is they'll come out and say, okay, things are starting to turn bad. And the first thing they do, like last summer, in the wake of that July meeting where they didn't cut, things started to turn really bad in July. Before the September meeting, what did they do? They released the meeting minutes that said, oh, by the way, we were actually talking about cutting. And then a bunch of Fed speakers came out and said the same thing. Oh, no. We were actually discussing rate cuts. We didn't do it, but we were talking about it. It's the same thing as you and I talked about last week or the week before with the Reserve Bank of Australia. How the Reserve Bank of Australia said, oh, we talked about doing a 50 because they think the psychology is part of this. As you say, the other side of what you just said, a worker who's out of work as a consumer, rate cuts aren't going to help them. Same thing for the business side of this, right? Employers who are having to trim hours and fire workers, which we're seeing more and more happen in the real economy, rate cuts don't help them either, especially in this environment. You and I were talking before we started recording about all of these different businesses like Lululemon and a bunch of other ones, Dollar Tree, that have said, our costs are going up and we cannot pass those along to consumers. So how is lower interest rates going to help Dollar Tree that's facing a massive profit hit? Well, lower interest rates are going to help at all. Dollar Tree is going to say, well, we're going to take the profit hit for a month, maybe two, and hope that it turns around in a couple months. But if it doesn't, what's going to happen? Well, lower interest rates are going to happen either way, and lower interest rates are going to help them. What they're going to do is they're going to start looking at all their workers, and they really don't have as many. They're going to start looking at all the workers they do have and saying, you're going to be part-time, you're going to be part-time, you're going to be out the door, you're going to be out the door. And it's not just Dollar Tree. All these businesses that are saying we're taking a profit hit from tariffs and rising costs, they're not going to continue to do that. They're not charities, as you always say, Steve. They're not here to be to just pay people no matter what. And so that's really the environment that the markets are starting to pick up on, is that, okay, there's a lot of business trouble here. It's not just about consumer sentiment turning sour. It's real world economics. I mean, small e economics.
Yeah, absolutely, Jeff. And you can go up to the manufacturing level and you can find there's a fantastic relationship between commercial industrial lending and new orders. So you think about what just happened, right? We had all this front running of tariffs. And what are we hearing from suppliers across the chain, manufacturers right down to the retailer? We've got a lot of inventory. Now, in some cases, we could argue they have a lot of the wrong inventory, but nevertheless, they still have a lot of inventory. But it starts to make sense because when a manufacturer gets a new order in, they don't have piles of cash around to fund it. They go to the bank and they borrow against that so they can manufacture. And then, of course, there's all this lending that goes on right through the supply chain all the way until it gets down to the retailer, who is already borrowing money again to get that inventory. So when you see a slowdown in demand, rate cuts really don't matter, because if I'm a manufacturer and my fax machine isn't whirring with a bunch of new orders, I don't need to borrow any money. In fact, maybe I need to go out and I've got a lot of things out there that I need to collect money on. But the bank's saying, look, why do I want to lend against that? Because we don't know when that inventory is going to sell. So people really think rate cuts matter. They do to the stock market because, again, that's the form of liquidity getting injected, and that's bullish for stocks no matter what the case is throughout history. And yes, if Fed cuts, stocks will go up. But in terms of the real economy, it won't make any difference.
Yeah, we're already seeing that around the world. Like I mentioned, the Reserve Bank of India reducing rates by an aggressive 50 basis points here, even as, and here's the other thing, even as bank loan growth in India has really fallen off sharply, because there's actually a direct relationship rather than an inverse relationship between interest rates and lending. You think that, with central banks cutting rates, first of all, central banks don't control market rates to begin with. That's a myth. That's a legend that's out. Don't fight the Fed. The central banks are all powerful. That's not true either. But what you actually see is that as central banks are chasing this weakness and lowering interest rates, banks are already risk averse, as Steve just said, because the other side of these businesses that are saying we don't need more loans because our business is falling off, the banks are saying, well, good, I don't want to give you any more loans because I see the same thing that you do. Your business is falling off. I don't want to lend to you. So in India is a perfect example. The Reserve Bank of India, which hadn't cut before this year, up until February, they hadn't done anything. Now, all of a sudden, they're cutting rates. At the same time, loan growth is falling off sharply because they're both reacting to the same things. And it's not just India. We see it in Europe. This week from now, we're going to have the Swiss National Bank, which is going to be right back at zero interest rates for the central bank rate, maybe even negative if the Swiss franc strengthens some more. And you go one by one at central banks all around the world. The Bank of Mexico has cut by 50 basis points 3 straight times too. And it's all for the same reason the Fed doesn't want to talk about, and that's economic uncertainty. That's actually not uncertainty. The economy is becoming more and more certain, not less. And so central banks outside of Jay Powell are reacting to that, as is the marketplace. And that brings us back to the 4-week Treasury bill yield and what may be happening up at the front of the curve.
Yeah, Jeff, I would say this just brings us right back to where the show started at 4-week, because what are banks telling us right now? Look, they're wanting collateral. Why would they want it? Because the economy is slowing. And what happens when the economy slows? People go into delinquency. Then they go into default. Banks start to panic because if the economy is booming, they probably wouldn't need the collateral that they want to have now. Again, just a red flag popping up in the system telling us the trajectory of the economy is going in the wrong direction.
And it's like I said, it's just a small one of those red flags that you want to pay attention to. But the point here is you got a red flag in the 4-week Treasury bill. You got a red flag in the Treasury curve. You got a red flag over here in the Reserve Bank of India. You got a red flag over here in the jobs report and actually what was in there. I talked about that in the live stream video yesterday. So you have all these red flags that are popping up. None of them say the world is ending, it's catastrophic. But you got all these red flags popping up, and it's you not only have to pay attention to it, you have to realize what all of this stuff means. And what it means is that Jay Powell is not going to be able to hold rates where they are for very long.